The fundamental reason why financial intermediaries exist is the provision of information. Intermediaries raise funds in one type of transaction, then pool them and extend these funds to their destination in another transaction. This often involves pooling and sharing of risk as well as maturity transformation. As an example of a financial intermediary, we will discuss the operations of a commercial bank, the most significant type of intermediary, before we move on to the broader question, which functions financial intermediaries serve in the context of asymmetric information. In the US, banks provided about $50 trillion in credit to the private sector in 2019, making them the largest and most significant intermediary. Banks raise funds through deposits, like for instance your checking account, and then pool these funds to return them into another type of asset, typically loans. This involves both risk sharing between depositors, lenders, and shareholders of the bank, as well as a transformation in maturity. Checking deposits, for instance, are very liquid, while mortgages, for instance, are not at all. Banks further have functions like payment services, and they are instrumental in the money creation process, a fact that we will discuss later in the course. Now, a natural way to understand any firm's operations is its balance sheet. If you have little exposure to accounting, let me just break it down to the most basic principles. Balance sheets have two sides, and they're often illustrated in a T-like structure, as is the case here. On the left-hand side are the firm's assets, and on the right-hand side are its liabilities and its net worth, or its capital, or its equity. According to the balance sheet equation, the value of assets needs to equal the value of liabilities and net worth. This is the case because liabilities and net worth, the right-hand side of the balance sheet, indicate the sources of a firm's funds. How, for instance, do banks raise their funds of operation? These can be external liabilities, like loans or supplier credits, or internal funds provided by the owners, such as, for instance, retained earnings from previous profits. Internal funds in the context of banks are referred to as capital. Often the term net worth and equity is used synonymously. The asset side, meanwhile, the left-hand side of the balance sheet, indicates a firm's uses of funds. In the case of banks, this may, for instance, be loans. Now, since all funds that flow into a firm must go somewhere, the right-hand side and the left-hand side of the balance sheet must exactly equal each other, hence the name balance sheet. The information in this particular case, what you see in front of you, is obtained from the Federal Reserve's Board of Governors website and is a couple of years dated, although this information doesn't change too much from one year to the next. It illustrates the composition of all US commercial banks' assets and liabilities. So for instance, checkable deposits were about 11% of all liabilities, while reserves or cash items in process of transition were about 14% of all assets. That's the way you read this. Now for banks, the largest users of funds are loans, and specifically real estate loans, think mortgages. The largest sources of funds are non-transaction deposits and specifically small denomination time deposits. Those make up for about half of all funds of banks. From year to year, the composition, as I mentioned, doesn't change much, but it has certainly over the years. If you were to go back 10 years in time, or really more 15 years in time prior to the Great Recession, you would notice, for instance, that real estate loans were a larger component during the housing bubble, or for instance, that bank capital was lower. We will return to some of these points after we discuss the balance sheet more broadly. Before moving on, we will need some accounting basics later, so let me quickly summarize the two major accounting principles. One, the value of a firm's assets must equal the value of its liabilities and its equity. The logic here is that every $1 in funding that flows into a firm must have some use. The consequence, and this is the second principle of accounting, is that every recorded transaction needs to address at least two entries in the balance sheet. This is known as double entry bookkeeping, and we will have opportunity to practice this later if you're not familiar with it. Just as a brief example at this point, say you deposit $50 in your checking account. This means that the bank gets an asset, that is cash worth $50, and a liability. It means it owes you now $50 in checking deposits. We add these two entries to both sides of the balance sheet, and that makes sure that the balance sheet in fact, balances. For the remainder of this video, I will quickly cover bank liabilities and net worth. The most liquid liability banks offer are checkable deposits. These are payable by demand. That means you can withdraw money at any time, but unlike other deposits, you can even use them directly as money. Historically, by using checks, nowadays you would mostly use your debit card. So you don't actually have to go to the bank, take money out of your checking account to pay with it. You can use your balance in your checking account directly. Banks pay no interest rate on checking accounts, and those funds are cheap for banks on that sort of consideration, don't have to pay interest, but banks still do not rely much on checking accounts for funding. The reason is, for one, that the serving cost is high. Banks usually have many checking accounts, and people tend to deposit withdraw all the time, which makes them costly to operate. Banks also need ATMs and so forth. Second, the fact that depositors can withdraw at any time makes it fairly difficult to plan with checking deposits when a bank is making its own investment decisions. 2. Non-transaction deposits, as the name suggests, are not money. These are the primary source of bank funding, and especially time deposits, which are also called certificates of deposits, play a significant role in bank planning. Savings accounts are similar to checkable accounts in the sense that they're payable on demand with some restrictions, but you cannot use them as money directly. In exchange, they may pay a small interest rate, but you will have to withdraw money physically if you want to use it. Certificates of deposits are even less liquid, as depositors agree to commit funds to banks for a fixed period of time. 3 or 6 months maturity, for instance, is common. During that time, you can only withdraw your funds at high penalties, and in exchange for committing your funds to the bank typically pays higher interest rate on uncheckable deposits because these assets are obviously less liquid. There's a liquidity premium here. 3. Banks, meanwhile, also borrow from a variety of other sources. This can include sources like the Federal Reserve or the Treasury, although these only typically act as an emergency lender during financial distress. Other sources like federal home loan banks or other banks, meanwhile, routinely extend credit to banks. Finally, banks may borrow from the corporate and the household sector, typically through securities or derivatives. Very common vehicle here are bonds. Now, let's be clear, the Fed is a central emergency lender for banks. This will come up again and again. And in this context, banks can generally request so-called discount loans or advances, although the Fed discourages their use unless the economy is in a deep crisis. The interest rate paid on such loans is the so-called discount rate, and it is set directly by the Fed. Notice, however, that this is not the policy rate the Fed typically targets within its monetary operations. Instead of borrowing from the Fed or the Treasury, banks more commonly borrow from each other. Interbank lending has emerged in relevance after the 1970s. In the US, the central interbank lending market is the so-called federal funds market. In this market, banks mostly borrow cash overnight from each other to meet cash requirements they have with the Federal Reserve, known as required reserves. More on that later. The interest rate which banks charge on such overnight loans is known as the federal funds rate, or the Fed funds rate in short, and it is the main policy rate in the United States. Notice that the Federal Reserve does not set this rate. This rate is in fact a market price, but the Fed targets it through open market operations, which we had discussed in the context of the liquidity preference model. Since interest rates then are related through risk and term structure, lowering or increasing the federal funds rate should also affect other interest rates, such as, for instance, deposit or mortgage rates, if not quite one by one. Other important interbank benchmark interest rates that will appear are, for instance, the London Interbank Offer Rate, or LIBOR, which is currently in the process of being phased out after a manipulation scandal in the early 2000s. Regulators in the US specifically are planning to replace it with the so-called Secured Overnight Financing Rate, or SOFR, which is another collateralized short-term interbank lending rate over the next couple of years. Finally, bank owners need to bring in their own capital sources. This includes startup capital, when a bank is founded, share capital, that is stock issued, and retained earnings, which are reinvested profits. Banks have to meet strict certain minimum capital requirements as a safety buffer during crisis, but also to set an incentive against moral hazard behavior. This idea, the idea of capital adequacy, capital regulation, is a core pillar really in the context of international banking regulation and will appear quite a bit once we talk about financial crises.